I think the 1997 analogy just says it's going from here to massive. How it gets there, I don't really know. I've got some reasonable clarity between now and end of year because there's a seasonality that is pretty observable. Beyond that, it becomes more speculative in nature because we don't really have the full signals. I think the adoption by institutions continues. And as we all know, they tend to do January asset allocation, particularly if it's a new asset class. Hedge funds have a new P&L. They tend to pile in. My guess is this cycle extends a bit further than people expect. But there will be a bear market. What is that going to look like? Is that going to look like the last one that we had? It's probably a mistake to think that because the players are different. Maybe it's longer. Maybe it's shallower. Maybe it's just choppy. Or maybe it doesn't do that at all. Maybe it just keeps having these sharp corrections down 50%. And then 6 months later, it's at new all-time highs again. It was 2020, that March to June period, that made me reassess my big macro framework because we knew what the central banks would do, but they did it harder and faster.
Yep.
And what we ended up with was the shortest recession in all recorded history and the biggest recession. That never happens. What we've done is we've created a reaction function in the central banks to do more.
Yep.
Because Janet and Jay will look at each other, high five, and go, we nailed it. The world stopped, and we only had a 2-month recession, and the markets recovered pretty quick. Now, we know that the reality of the underlying economy and other things is not so great, but for the central banks, they're going to do more of this. Why would they not? They're now thinking, do we need a business cycle at all? But what they're doing, if you actually look at it, the central bank balance sheets, the big G4 central bank balance sheets, are growing at about 15% a year. So I started thinking this through. I know a lot of people use M2 as a way of understanding printing, but I just thought I'm just going to use the balance sheets because that's new stuff that we know that they're doing. And I know that there's it's not a pure way of flowing into the economy, whatever. But anyway, so I put the S&P against the Fed balance sheet, and all of us have observed that correlation over time. And the thing was, it kind of told us what we deep down know is the S&P's kind of gone nowhere since 2008. It fell in 2008, the money printing came, and the S&P's basically been going sideways. And then I looked at gold, and it kind of had even underperformed the Fed balance sheet. I looked at real estate, it was identical to the Fed balance sheet.
Yep.
I then looked at the NASDAQ, and it had done better because it had all these network stocks in it. And then I looked at Bitcoin, it was like, oh, this is a whole different world. Mm-hmm. So there was only one asset that looks like it offset the printing of money. So if you know that, and you are able to trade it, then let's say we go into your quad 4, what are you going to buy?
Right.
Well, the highest upside is going to be crypto. So I looked at this, and I looked at all the global asset classes. So equities, about 250 trillion, bonds, about 200 trillion, real estate, about 350 trillion, derivatives, 1 quadrillion, FX markets, about God knows how many quadrillion. So I looked at that and thought, okay, we can see the trend rate of growth of adoption. We know that equities are going on the blockchain, bonds are going on the blockchain. The European Central Bank is already looking at the French Central Bank, a bunch of others. So that's going to happen. So bonds and equities go on the blockchain. People are already starting to tokenize real estate. Well, this is kind of a super asset. Now, I don't assume it eats all of them. It could do in the end because they'll still exist, but they'll be basically on the blockchain. But if I'm right about crypto, then it's currently a $3 trillion asset class. And to be reasonable, it should be worth 200 trillion. Well, that's 100x, Keith, of an asset class, probably in 10 years. You and I, nobody, in fact, has ever seen that in all recorded history.
No.
And that makes, and what I like about it, why you say you're all in, is because I can be a total idiot, pick the wrong thing, much like you can do with equities, and you've been able to do since the 80s, is just pick anything and it goes up. And so it's kind of idiot proof. Now, yes, like equities, there'll be bear markets. But if I'm right, and we're going from 2 trillion to 200 trillion, the entire asset class is going up 200x. Now, it doesn't mean it goes up in price necessarily 200x, but the opportunity set's going to be enormous.
Yeah.
So that's why so many of us are focused on it. If my framework is Metcalfe's law and it's all about adoption effects, then you want to look for the communities or the tokens that are growing their ecosystem faster.
Right.
DeFi comes along, it's all built on ETH. NFTs come along, all be built on ETH. The number of new wallet addresses growing is happening faster at ETH. So what you've got is the network is growing faster, and therefore the price should be going up faster. Simple as that. I mean, once you understand this Metcalfe law thing, it's actually all pretty easy to understand. And you just have to abandon linear charts and use log charts. And once you see the log chart, you see the trend. It's pretty simple. It gets to like 2 standard deviations overbought versus the long-term trend. It then corrects for a period of time. And, you know, on a linear chart, it looks horrific. Everyone goes, see, you know, this crypto's worth nothing. But on the log chart, just goes down to 1 or 2 standard deviations oversold and starts all over again. And it's the same that Google's done, Facebook's done, Apple's done. They're all the same. I did a video that became, I don't know, one of the biggest videos I've ever done. It's like 2.5, 3 million views, called The Retirement Crisis. It's on YouTube. And one of the things I said is, listen, if you are a 30-year-old millennial, you're pretty fucked right now, because the expected future returns out of equities with all-time record high valuations and the boomers needing to sell them over time, same with real estate, same with bond yields, your ability to generate the same kind of wealth that your parents generated, the baby boomers, is precisely zero. And I actually said you've got one chance, and that chance is crypto. Because you can take risk at your age because you've got nothing to lose.
Right.
So we all know there's 2 times to take risk. One is when you've got nothing to lose, and one is when you can afford to do it. So when you've got nothing to lose, that was March 2020 into September. They were being given a check, $1,200, not going to change their life. They're stuck at home. They don't need to spend it. So they go on Robinhood and they discover call options. Brilliant. And guess what? It worked. And suddenly 86 million millennials got financialized all at the same point. But they're risk takers. They understand crypto. They understand risk taking from gaming. It's very different. We were taught different things, and the parents of the boomers were the silent generation, and they were much more risk averse because of the back of 2 world wars. So now we've got a group that have never seen stuff like that before, who have a lower wealth of their age than any previous generation in history, and they've seen an opportunity. So they're going to swing from the fences. And that's changed the structure of the option market. Makes me laugh because everyone's like, the option market's crazy. Look at this complete exponential use of options. This is a bubble. No, you've just bought 86 million millennials and probably, I don't know, 50 million, 70 million Gen Z into the investing base and give them Robinhood options, and they can't lose more than they put in.
Yeah.
Go for it. Right? Why the hell not? We all have to learn the hard way, and we also need a few victories. And that way, they might be able to speed up that process, because you can lose money pretty quick, but you can make some good money quick too. And what's really interesting is these people are all coalescing on a platform like Reddit and talking about their losses, Keith. Our fucking industry is built around, excuse my French, built around people who don't want to talk about losses because it makes them look weak. These guys are laughing at their losses and saying, I learned from it.